kick things off, we have our oil and gas investment panel. So I'd like to welcome Andrew Harwood, Research Director, Corporate and Upstream Research at Wood Mackenzie, Iain Lawson, Head of Origination for Asia at Mercuria Energy Trading, and Anurag Sehgal, Principal at Noble Group. So thank you for joining us today. And I'd like to kick off the panels with just a short introduction by each of the panelists to just share a little bit about themselves and what you're currently focused on. So, Anurag, maybe you want to kick us off.
Morning, everybody. I'm Anurag Sehgal, as Amy has already introduced. My key focus areas at Noble Resources are basically carbon steel materials and also macro coal-based analysis to help our trading desks. I work in the research team over there, and before Noble, I have worked with Brookings Institution, extensively focused on India in their coal research, coal energy research, and published a book as well for on coal in India, how to transition away from coal last 2020 in 2021. I'm a mining engineer by education and a policy graduate from IIM Bangalore in India. Thanks.
Hi guys, my name is Andrew Harwood. I've been part of Wood Mackenzie's Upstream research team for 17 years now this week. Since 2010, I've been based in Singapore, so focused on the oil and gas E&P sector in Southeast Asia and the wider Asia Pacific region, looking at everything from exploration, licensing, production, development, all the way through the value chain to decommissioning. And in the last 2 or 3 years, I've taken on responsibility for some of our corporate research in region, so looking closer at the strategy, the financial positioning, increasingly the energy transition outlook for companies that are headquartered in Asia Pacific. So looking at some of the national oil companies in Southeast Asia and China, and looking at some of the big independent E&Ps in Australia as well.
Good morning. My name is Iain Lawson. I head origination for Mercuria here in Singapore. I've been with them for around 2 years. Mercuria is one of the largest of the independent trading companies, and we've been doing a great deal on the energy transition space. My boss has come out and said that in the next 5 years, his expectation is that 50% of our investment is going into clean tech, low carbon, and renewables. Now I joke that I thought I was joining an energy trading company, but it feels much more like a renewables fund. My role is fairly diverse. We're trying to build a derivatives and risk management franchise. We look at structured finance, prepays, commodity-linked finance for upstream companies, midstream, across pretty much everything from coal to ags to iron ore to gas and oil. But the biggest area of growth is very much in the energy transition space. In terms of background, I'm a physicist. I began my career with Shell, was investment banking for a while. I was Goldman and Citi, and went back to BP for about 8 years. And as I said, joined Mercuria at the beginning of last year.
All right, great. Thanks for that introduction. And so to kick things off, actually, I just want to remind the audience that we will be taking questions. So if you have any questions at any point for our panelists, definitely just put your hand up and we'll bring a microphone over. So I thought we could start looking at kind of the global geopolitical situation, things like the Russian invasion into the Ukraine. How are these impacting the industry over the past year or so? Whoever wants to start, sure.
It's been a very, very interesting time as a trader, because in general, trading and volatility go hand in hand, and we've just not seen a volatile situation like this on the oil and gas side, particularly the gas side. When people hear the idea of being a commodity trader, they assume that it's all about making big speculative gambles, but it's not. It's really just about recognizing dislocations in dislocations in geography, dislocations in quality, dislocations in time, and then putting on a position that allows you to take advantage of that dislocation. So we're in a situation where we're seeing dislocations like we haven't seen before. Obviously, taking that much gas out of the European environment when things were already fairly volatile has had massive knock-on consequences. It's probably accelerated the whole green energy transition by 5 or 6 years, just because I think there was always an expectation that you would move from oil to LNG, from LNG to blue, like with carbon sequestration, and eventually to green. But Ukraine has just accelerated that whole process. It's also led to almost a separation of commodities. It used to be that if you wanted a counter-inflationary hedge using commodities, you would just buy something like the Goldman Sachs Commodity Index, which had a little bit of everything thrown in there. What we've seen is a massive separation of energy commodities and infrastructure commodities. If you look at how oil and gas have performed relative to, say, iron ore, you have oil and gas driven by Ukraine, you have iron ore driven by the growth situation in China, and they're both going in radically different directions at the moment. So just the breakdown in historical correlations between commodities is something that we are still getting our heads around.
Yeah, I think for Wood Mackenzie, looking at the sort of oil and gas space, 2020, 2021, very much about this sort of growing momentum behind decarbonisation and the energy transition. A lot of focus on looking at sort of future sources of low carbon energy and perhaps a de-emphasis by certainly the larger players of investment in the sort of conventional oil and gas businesses. Post sort of COP26, we saw a raft of new sort of net zero pledges, very much a focus on, as I say, that decarbonisation trend. Obviously, the conflict in Europe has really brought home, I guess, the continued reliance that we believe the world will have on oil and gas, and this transition being a long-term transition rather than any kind of short-term switch that people perhaps would like it to be. It's really brought home perhaps as well that level of underinvestment that we've seen in the conventional sort of oil and gas space, that continued sort of focus on capital discipline that the larger operators have maintained. And I think that sort of probably expands across and beyond just the oil and gas space, probably into some of the other commodity sectors. So we are seeing a bit of a rebalance towards security of supply, being less reliant on single sources of supply, and bringing a bit more balance to this sort of energy trilemma that you hear about, in terms of affordability, security, and also sort of the sustainability side of certainly oil and gas.
So I'll thank you. I agree with both the panelists. I just want to come in from a different angle. I'm not as much in oil and gas, as much in coal. Noble does more coal trade. So for us, the situation was changing even before, I think, in some ways, because there was some geopolitical disconnections in terms of China trying to enable and ensure its energy security by kind of going all in its own coal mining itself. So they have, and I've seen that kind of happen this year with or without Ukraine crisis, kind of China upping its coal production manifold. It's already decreased its share of the seaborne coal trade. At the same time, Europe, for example, has, and that's after the Ukraine kind of situation snowballing. It is, there's no choice. I mean, it has to come back to the body of coal, right? There were flows which had dried up, and as Iain mentioned, it's all about identifying those dislocations in some ways in the trade flows, right? So coal, which had kind of not vanished, but kind of reduced substantially from the European region, has is bound to see some uptick. There have been plants which were mothballed, for example, power plant engineers which were, maybe retired, and they're now being called back in some ways to understand and see how they can restructure the existing power plants to run coal of different configuration which used to be earlier. There were readjustment of coal flows from South Africa, for example, into the eastern region, the areas like India, for example, which was at that point in time an anomaly. Lots of it used to go to Europe, but now it's starting to probably come back. So yeah, I think there is a lot of structural changes which we are seeing, and it's a very interesting development in the world, which is more and more vocal and more conscious about sustainability in some ways. And but this is what we are in right now. The market is tight. Yeah.
It's funny, there's almost a kind of overshoot going on as well. Before Ukraine, the momentum away from coal, away from oil and gas, in terms of bankability, in terms of sustainability, it was extremely strong. Now that there's very obviously demand for coal and gas and oil, the banks haven't necessarily reversed the decisions they made about what they were willing to and not willing to finance. So not only are we trying to work out how you finance some of these new technologies and products that people don't necessarily fully understand yet, but they're also trying to work out who's left to finance these old traditional ones that the banks have simply stepped back from. So, I mean, that's a tension that hasn't been resolved yet either.
I mean, that brings me nicely into the next question, looking at, there hasn't been a lot of investment into new projects over the past few years. So how are investors and companies addressing this sort of capital shortage?
Well, I think, if we look back at maybe the sort of the early 2010s out to sort of 2016, we saw huge levels of investment, but perhaps not in the most efficient means, certainly in oil and gas. If you looked at places like the Permian, companies were spending over 100% of their operating cash flow reinvesting in, exploration, drilling, etc., but not actually generating profits. And so in the period since that sort of 2015, 2016 price crash, we saw a real sort of restructuring, streamlining of operations, a cutting of any sort of non-core operations, and a real focus on beginning to generate meaningful margins and cash flow. And so, certainly in the oil and gas space, the best operators are really well positioned for stronger prices now, but it's sort of come at the expense of that continued investment in new sources of supply. At the moment, we're seeing around 30 to 40% of operating cash flow being reinvested in new supply. The rest of that cash flow is being ploughed into repairing balance sheets, which are now at pretty strong levels, and also flowing back to shareholders so that the oil and gas sector can sort of remain attractive to investors in the wake of this sort of decarbonisation theme. 2023 in the oil and gas space, we expect to see perhaps a 10 to 20% increase in capital budgets, but around half of that is going to be eaten up by cost inflation. The cost of rigs has gone up, operating costs have gone up as diesel and energy prices go up. So that 20% uptick in investment doesn't necessarily mean it's a big increase in activity. It's actually we're probably going to still stay on this sort of muted level of new supply coming in, which is arguably going to maintain this position we're at in terms of commodity prices.
I think you've covered everything mostly, but I would just want to say that there's definitely a challenge, I think, in terms of investment. There's definitely the cost pressure, the inflationary cost pressure, which is raising cost of investment. But as we see increasingly with the geopolitical disconnect and the implications that we are seeing of this Ukraine conflict, the world is, I think, with respect to energy, it's a lot of pain for the consumers, and there is a less there is less choice. Again, I'm speaking from the gas and coal perspective as opposed to a oil perspective per se. So they have to be with the Nord Stream kind of not available. Europe has to look at, say, for example, regasification terminals. Like a lot of regasification capacity should be built. Is what my understanding is going forward. Um, there will be, of course, rebalancing of flows in terms of gas from various regions of the world going out from, say, cutting off some of the supply from Asia and moving it into Europe, possibly, which is already happening. So yeah, it's a challenge, and uh, it just means that there's going to be some more tightness in this market, at least in the near term, for sure.
I think another thing that's worth pointing out is that before Ukraine, there was very much a push to, if you like, disaggregate companies that had a dirty part of their operations. You saw people like AGL trying to turn themselves into like a clean generating company and the dirty coal side of it. There are other companies that have been looking at doing the same thing. And that's led to, again, some, I think, distortions in the way that people are investing. If you are an oil company like a BP or a Shell or a Chevron, and you've told your shareholders that you have to pivot from oil and gas to something that's much cleaner, your options are limited. That's why I think we saw all the big oil companies chasing offshore wind, because there's not that much that moves the dial on a company the size of a BP or a Chevron. So offshore wind's one of the few things that does. So what we saw, obviously, were yields driven down, multiples driven up, and lots of people chasing a few fairly limited assets. We're seeing that with some of the new products as well. I think one of the reasons that a BP would have bought into the Asia Renewable Energy Hub in the Pilbara, now the big green ammonia project, is scale. I mean, this is a 28 gigawatt solar to ammonia project. And for BP, Shell, Chevron, everybody else, finding something that's big enough to move the dial in a developing industry isn't necessarily the easiest thing. So I think there's still a willingness for these companies to put money into the oil and gas, but they feel that they have to be balancing things out a bit. And finding things to help that balance is just not straightforward.
And I think on the sort of investment side, you've got to look at financing as well. I think Iain mentioned that previously. There might be a bit of a sort of bifurcation of the market in certainly in the oil and gas space. You know, the bigger players, given where prices are at the moment, they're all running at sort of gearing below 10%, or they're certainly targeting sort of zero debt on the balance sheet. And that means they're in a really strong position to finance projects themselves. Whereas, you know, at the lower end, and perhaps that's relevant for many of the smaller operators that are here today, the finance industry has put its own sort of decarbonization and emission reduction targets in place. You know, we have the Glasgow Financial Alliance for Net Zero is a group of or an alliance of financial institutions, ratings agencies, advisors that have around $130 trillion of capital under their sort of control or guidance, and they have agreed to put in place sort of 2030 emission reduction targets. And so for anyone that wants to tap that source of potential capital, you need to align with these finance organizations' targets as well. And so, for the smaller operators that are looking to go in and raise capital, you need to really be thinking about your sort of ESG and increasingly your decarbonization sort of strategy.
So, energy security and accessibility, I guess, has been a huge issue lately, mostly coming out of this global situation. How do you find a balance between energy security while also addressing the transition? So, how, just in terms of maintaining energy while still focusing on the transition?
Well, depending on which part of the energy transition you're looking at, it can actually be a way of increasing security rather than diluting it by moving away from traditional sources. We have a company, Minerva, which is a big bunkering arm, and our expectation for the way that things would move would be, we run on oil at the moment, we gradually transition to LNG, we go from LNG to something involving carbon capture, like something blue, and eventually, as technology matures, we perhaps move to a green economy. What Ukraine has done has more or less short-circuited the LNG and blue parts of that. LNG is probably too expensive to use as a shipping fuel, and it doesn't really get you where you need to be for IMO 2030. LNG as a bunker fuel means you have methane slippage. If you look at the whole well-to-wake economics in terms of carbon, there's just no way it gets you to where you need to be. The IMO target is, I think, a 50% overall cut in the global fleet's carbon emissions by 2050, which in practice means about an 85% cut vessel by vessel when you consider the expansion of the fleet at the same time. And there's simply no way that you can get there using hydrocarbons. So to an extent, the market circumstances are forcing an acceleration from LNG and blue to looking at green. And that's where the security element comes in. Blue, or a blue hydrogen economy, was never actually going to help the security position, since it's really just gas with extra steps. For anyone who's not familiar, blue hydrogen or ammonia or methanol would be made from natural gas, where you've cracked it down, you've captured the carbon dioxide, and you've sequestered the carbon dioxide somewhere else. Green is where you've manufactured it directly from renewable power, and you've cracked water into hydrogen and oxygen. So if what you're doing is taking sources of renewable power that don't otherwise have a market, and if you think about, say, Chile or South America or Oman or the Pilbara Desert in Australia, these are all areas which have fantastic potential for renewables, but don't have demand because they don't have population centers near them. So if instead what you can do is take these stranded renewable opportunities and turn them into electron manufacturing plants that can then be turned into molecules so that you can then ship to an end user, then you're actually adding incremental power into the global economy, rather than simply making the existing energy get to market in a less efficient way. So I think going directly to green can dramatically improve energy security, but it won't happen immediately. I mean, the lead time in these things tends to be huge. Some of the big gigascale projects, they're not really going to come on scale till 2026, 2027, and the issue that we have at the moment is immediate. So it will help, but it won't help immediately.
Yeah, I think if we think about it in terms of, again, that sort of decarbonisation theme, I think short-term concerns over security of supply are going to have an impact there. Obviously we see global gas and LNG being sort of drawn into Europe by the need there, which takes it out of Asia. It means high prices in Asia are now or LNG prices are now connected to European LNG prices or gas prices, which means that we're probably going to see some demand destruction for gas and LNG in Asia, and that demand will be substituted by coal and other sort of probably higher emission sources of energy. So we are going to see a short-term impact on some of those emission targets that some of the governments and national companies have in this part of the world. But I agree with Iain that I think we're also going to see an acceleration in that longer-term transition. The oil and gas sector at $100 a barrel in 2022 is going to generate surplus cash flow of around $550 billion. Now, as I say, around about a third of that is going to go towards new sources of oil and gas supply. About a third of that is going to go to shareholders or to strengthening the balance sheet. And a large share of that is also going to go into sort of building up the technology and building up the scale of these lower sources of lower carbon sources of energy. All of the sort of European majors are targeting in excess of 30% of their capital budgets to go towards low carbon. I think BP by 2030 is targeting 50% of its annual spend will be on low carbon sources of energy. So you can really see, the cash flow and the profits that are being generated today are really going to fund the acceleration of that longer term transition, which I think we'd all agree is positive. But the other side of things is to do that, to transition, you also need, the precious metals, the future-facing commodities that are going to help drive that electrification and that investment in new infrastructure, which, again, I think is probably a positive message for people at the conference today.
Yeah, I'd agree. So one of the key things that Andrew just pointed out is in terms of having the precious metals, the rare earths, for example, to fund some of this transition away into various sources of renewal, right? And that is where the challenge is in terms of international trade in some of these commodities, given that we are facing more and more disconnect in global diplomacy. There are supply chains which are under pressure, usual supply chains which are under pressure. Of course, there will be new supply chains which will be formed because of this pressure. There will be movement away from the conventional systems that we are seeing, new alliances forged, which will mean the entire, rare earths, etc. All these specific minor metals which are required to manufacture for energy security, for example. Even if renewables, you're talking about renewables, solar, etc. You need solar panels. And there's a lot of capacity which exists right now in Germany and China, for example. But for other countries, they have to typically import, right? With the problems with the problems in global diplomacy and trade, I think that will challenge more and more countries to seek more indigenization of their supply chains, which will mean that they will want to invest more and more in precious metals in their local economies. And of course, use of technology to enable more and more manufacturers to come up with support routes to on-stream more renewables and alternative fuel technology. So that's another challenge where an opportunity possibly lies as we move forward, as the world tries to transition away from these fuels. In the short term, though, as Andrew also mentioned, we do not. I don't think there's any doubt that there will be an incremental gain in carbon emissions in the short term as countries, companies figure out where to invest, get more certainty in terms of their investment and the value chain associated to support those investments in those economies.
Yeah, I think that's one thing that the oil companies are still getting their heads around. Now being an energy trader means being a metals trader. The structures that have been in place in the BP Shells and Chevrons haven't necessarily fully digested that yet.
And so, you've talked a little bit about this, but what about the idea of using, gas as a transition fuel? So just, I don't know if it's the label of a transition fuel, but how is the industry kind of looking at this idea?
Well, it's a key part of decarbonization strategies for many of the companies operating in the oil and gas space. Gas, when combusted, is I think 50% less carbon intensive than coal, and so it is that sort of natural bridge towards sort of zero emission sources of energy. All of the big players have their big sort of gas strategies. They obviously heavily invested in LNG infrastructure around the world. But it takes 5 or 6 years to bring on a new LNG plant in given a strong wind and the best well in the world. It also ties up huge sums of capital. So these are not projects that companies are just making willy-nilly or making decisions on willy-nilly. And so it needs to be, they need to be the right projects, they need to be robust, they need to be sustainable, and the sustainability of new sort of oil and gas investments has never been sort of higher on the agenda. You don't see a new final investment decision on an oil and gas project these days without an associated net zero pledge for that project. Carbon capture is going to be a huge part going forward as well. We have companies in this part of the world and elsewhere building their entire sort of transition strategy around, allying their conventional oil and gas business with a carbon capture capability, which will allow them to continue to produce oil and gas in a sustainable and low emissions manner. But going back to the point, we definitely see gas as being the more resilient commodity, even in our accelerated energy transition scenario, which aligns with a 1.5 degree sort of global warming. We still see continued growth in gas demand through the next decade and probably beyond 2040. And in our sort of base case outlook, that gas demand continues to grow through 2040. So it's clearly going to be a key part of that sort of longer term transition strategy.
Yeah, I mean, the majors in particular see a huge role for gas as a transition fuel, and they're leaning very heavily on the idea of blue, the idea of kind of blue hydrogen, blue ammonia, blue methanol as a solution to the carbon emissions of gas. The problem with the blue process is that it involves finding places that you can sequester carbon dioxide safely and permanently. And that's not something that scales in the same way as green would. If you need, for example, a lot more green hydrogen, then you just need a lot more sunny land, a lot more electrolyzers, a lot more PV, and it's just a case of scaling it up. If you need to be capturing an awful lot more carbon dioxide and sequestering it somewhere, it's almost like exploration in reverse. You've got nothing guaranteed about the geology of a formation. So I think that if the blue economy does start to develop, then we'll see a lot of constraints around carbon sequestration as a choke point, simply because the actual practical commercial carbon sequestration opportunities at the moment, there's only a handful of them. There's a couple in the North Sea, there's a few in the US, there's one or two in Australia, but they're not proven, and the jurisdictional processes for what happens if one of these leaks aren't really dealt with yet. So I think I find it hard to get too optimistic about the blue angle, and the blue angle is vital to gas being an actual transition fuel rather than just business as usual.
Just one more point to add away. I think the gas prices where they are right now, I think it also throws a spanner in the transition aspect as well, right? No one imagined maybe 6 months, even 6 months or 1 year ago, that the gas will be at the prices that it is right now. So I would say that there will be in some quarters a rethink if this price is going to stay as it is and for how long, and that would reshape the kind of investments that are happening in associated transition infrastructure as well. So I think on a long term, I think I remain hopeful that this would serve as a transition fuel, as Iain and Andrew mentioned. But in the short term, I think there will be some kind of rethink possible in some of the investors in terms of gas prices and its availability and the ability to be used as a transition fuel for the short term, I think.
Just on the bunker side again, I know that some of the majors had people allocated to LNG as bunker fuel, and they've pulled them off that and put them onto hydrogen and ammonia and methanol as shipping fuel. So there's been almost already a step back from gas as a transition fuel for shipping in favor of some of the greener alternatives.
Interesting. Before we start to wrap things up, do we have any questions from the audience? Okay. So, think to wrap things up, it would be good to just hear some final thoughts, the outlook for the industry moving forward, and what you expect to see over the next few years.
Sure. I mean, I think it's going to be a really, really interesting time because the industry already today doesn't look the same as it did 5 years ago. Like I said, to be an energy trader now involves trading metals, it involves trading carbon, it involves understanding the interplay between oil, gas, power, carbon, everything. You have to be much more connected rather than being able to trade, say, gas in isolation or oil in isolation. It really is now a single integrated energy market. In terms of where things are going, the Ukraine situation has obviously generated tensions and fault lines that didn't exist beforehand. They will definitely accelerate the whole transition to green in some areas. They will slow it down in others. But I think it's going to be a very interesting time to be a trader just because volatility is what we do. It's not going to get easier to finance things. So if a company was looking to raise finance pre-COVID, oil prices are higher, gas prices are obviously far higher, but at the same time, interest rates have taken a massive step up as well. So the challenges of financing a project are getting more complex, and there's very few areas where it's an obvious slam dunk that you'll easily find finance. It's hard to think of a project that people will point at and say, yes, that absolutely fits, no questions asked.
If I think about the outlook, I think about the questions that are sort of front of mind for CEOs across the sort of the oil and gas space. We hosted in Singapore a few weeks ago our Asia Pacific Energy and Natural Resources Summit. We just hosted a similar event in London. I think we've got Houston coming up in the next couple of weeks. The key questions that we found people were asking at those events were, or the key takeaways were that this continued need for oil and gas, this continued need for new oil and gas investment, but it needs to be done in a sustainable manner. So that means focusing on not only the sort of emissions and the environmentally sustainability, but also from a sort of an economic sustainability. So it means focusing on projects that are resilient to volatility in prices. Projects that have strong margins, projects that offer fast payback. But again, projects that have those sort of lower emission footprints. And that comes to the second point that people were talking about, was around finance. And Iain mentioned how challenging it may be to gain finance going forward in the future. Again, the need to align with what financial institutions are targeting in terms of their portfolio, in terms of the emissions reduction, the sustainability of their portfolios. I think if you're going out there looking for finance, then you need to align with some of those sort of guidelines and regulations again as well. So finance is available, but it's getting tougher to access, and we believe in a continued sort of need for oil and gas, new oil and gas, for at least the next sort of 2 decades.
Yeah, so I think no one expected us as a world where we are right now in terms of the conflagration of conflicts and dislocation of value chains, the challenges with coordination at multilaterals, etc. But unfortunately, this is the world we are in. There's definitely a temporary setback for our sustainability agenda, as a world. It's the world is unpredictable, more so after COVID, and people are, because of this unpredictability, there is an opportunity for some people asking important questions in terms of maybe the way of thinking that we used to have earlier. Does it need to go a massive change in terms of, say, talking about transition fuels, in terms of financing those transition fuels? There are going to be some innovative technological solutions possibly coming up. I mean, of course, in a short term, none of these is possible. It's going to take some time. But we're going to see more and more energy security, clamor for energy security, energy independence from countries, various countries. There's going to be I'm sure there's, and it's already probably happening, there's going to be rethink in nuclear, for example, also in some quarters, right? People are going to talk about market, there's a whole lot of diplomacy associated with nuclear suppliers as well, nuclear construction and so on and so forth, NIMBY, I mean, so many issues over there as well. But what I'm trying to maybe underline is that this is a world that is more unpredictable in terms of what we have seen in the past couple of decades. It will need new answers to the challenges that we are facing now in terms of what we were the way we were addressing it earlier. And yeah, so bring it on, I think.
All right. Well, that I think is a very nice place to wrap things up. Thank you to our panelists, Iain, Andrew, and Anurag.